All right, welcome back. We're discussing earnings with the management of Happiest Minds now. Mr. Narayanan joining us, the MD, as well as Joseph Anantharaju, the Executive Vice Chair. Got lots to discuss with them. Venkat, congratulations. A good quarter coming in. Revenue growth has been healthy. Margins also have been seeing a sharp expansion of about 300 basis points, in fact, quarter on quarter. What led to that?
Levers for margin performance have been largely revenue growth. So we had put out the numbers on dollar. We have grown about 8.8% year over year, and about 2.2% 9-month over 9-month. So if you look at it, the real good growth in revenues in dollar terms, which then translates to good growth in rupee terms, has been one reason. Followed by utilization, we have hit about 81.6%. That's kind of a high for us. And the continued benefits of COVID, savings from COVID, the pandemic, work from home, reduced travel, reduced other costs, administration costs, they continue to accrue to the P&L. So all of this together continue to give us that kick up in the EBITDA performance that we are talking about. So we have grown EBITDA by about 1364 basis points on a year-over-year basis and about 337 basis points quarter over quarter. So that's a significant uptick year over year and a quarter over quarter basis. We are currently at about 29.7% EBITDA for the quarter, and it's about 27.3% for the 9-month period.
Sure. Joseph, we've seen healthy revenue growth so far, and verticals like edutech, high-tech, BFSI, they've all reported strong growth as well coming in. Give us some color on the demand picture across some of these verticals.
So, if you look at the verticals, when we spoke last quarter as well, I had mentioned that we are seeing quite a bit of traction in edutech, high-tech, and e-commerce part of retail. And we also started seeing, good demand in the online media, or the entertainment and media companies that are offering similar to Netflix and others, over-the-air kind of offerings. So we started seeing quite a bit of momentum building up in December when the budgets got fixed and got open, and we started seeing new requirements coming in, which we are seeing, ramp ups in Q4. But a couple of other areas which were not very clear in Q3 and December, we've again seen traction in January, are in the industrial space and in the logistics, the distribution space. Both of these again are seeing quite a lot of digitization. So these are some of the verticals, and so we're seeing pretty strong demand. So it's all about execution now, making sure that we take this demand and able to help our customers out with their business problems.
Just adding, we have, if you look at the demand, Joseph mentioned about the strong pipeline in the press release that we put out. So that's really the new business that we are talking about, or the existing new business, net new and existing new. But coupled with the fact there is also pent-up demand, which is getting released from our existing projects itself, because they wanted accelerated delivery. Timelines are getting, they are shrinking the timeline. So to that extent, there is existing demand also now slowly picking up. So if you look at it, when we talk about demand, you should look at both the expansion of the current existing projects and also the new projects that are coming up. So there's pent-up demand which is building up in the system right now.
Right. Venkat, large players like TCS and Infosys expect growth of about 22% for FY22. Can we expect the same from Happiest Minds? And also, how is it that you see growth across your major verticals and deal wins?
So I'll take the first part of the question. So if you look at our growth, we don't give guidance, but we had given some reference points during our IPO roadshow and subsequent results pronouncements. So we have been saying that FY21 was indeed, I would say, not so good year in terms of growth. We are looking at about 2.2% growth, 9-month over 9-month, and hopefully by the year maintain that and better that on that. But essentially make up for all of that lost growth in terms of profit, which is what we had said, and we are kind of sticking to that kind of statement. Now, if you look at FY22, the word that we had put out is we will get back to the same growth trajectory that we had before the pandemic. started, which was we were doing about 21% growth on our operating revenues, and that's something that we plan to get back to, and that's the target or the aim to do that on an organic and on a CAGR basis to keep up that 20% growth kind of a number. We have also said that we'll be doing twice the industry growth rates. So hopefully the industry is, let's say, about 9-10%. We should be double of that, which is kind of the number that we have been doing for the last 3 years. And that's what we'll be looking to do in the coming years as well.
In terms of verticals, we're seeing strong demand across all the verticals that I mentioned. And maybe I'll take a minute to give a little bit of flavor of each. If you look at education, some of the initial activity from our customers, EdTech customers, was on supporting remote learning. And now what they're looking at is how do you do give a better experience to students in a hybrid learning, because some students may be online, remote, some students could be doing in person in class. And how do you make the experience more end-to-end, more adaptive, predictive learning, driven by data? So that's what we're seeing in the EdTech. So those investments will continue because the current learning mechanism, which is hybrid, is expected to continue for the near future at least.
Venkat, while we've seen very sharp margin expansion, can it really be sustained going forward? Because there will be salary hikes from April 1st onwards, and with the economy now opening up, will we really see benefit of lower travel costs actually fade away, say 22 to 24%?
That's a nice question because off task. We are currently at about 29.7% for the quarter. Like you highlighted, it is indeed the highest for a quarter for us, and very happy about it. While I answer about the question on sustainable margins, coming to sustainable margins, I've been long holding a number of 21 to 23%. But looking at many of the cost benefits that have happened or the efficiency gains that we have got over the previous couple of quarters or even 3 quarters, we are not letting go of them very easily. So we are going to keep a tight watch on those costs. But trust me, we will not cut down on customer expenses or anything that's required from a delivery standpoint or investment that's required for the business. But considering that we take the salary hike costs that you talked about, get back to traveling, but keeping or retaining the efficiencies that we got from the last 9 months or 4 quarters, I'm now thinking that our numbers should be in the range of 22 to 24%. So that's the kind of sustainable margins that we need to work on, and that's what we'll be doing.
Okay. Venkat, in our last conversation, you'd also mentioned possibly looking for smaller acquisitions in the range of 10 to 30 million, I think you'd said. What's the progress on that front? Any deals that have been finalized?
So happy to state that we have closed our first acquisition post going public. We had put this out in the public domain through a notification to the exchange. We didn't go for a press release because it was just very close to our result update, result time. It's a $10 million company. It's in the area of PIMCore Global Services. It's called PGS Inc. That's an America-based company. So we have acquired that company. So the details are there on the website, and the results will also get integrated, or that will roll into our Q4 results, and we will get the impact of the entire business and the revenues and profits going forward. So that's on the first acquisition that we did. We are continuously looking and monitoring the space. We are looking for companies between 10 to 30 million. You're absolutely right. That's the kind of range we are looking. Very expensive digital assets, but largely focusing on capabilities, competencies that we need to build within Happiest Minds, spaces which span across the entire digital spectrum. We are okay with any geography, but it should be profitable, digital, good management, good customers, and they should bring in some certain competency or capability onto the table. So these are the benchmark points that we are comparing our targets that are brought into, continuously looking at names, if I were to talk about that pipeline.
Okay, and Joseph, Now, you've also recently expanded in the Middle East. Let's talk about that, the kind of opportunity you see there. You've got a large presence at the moment in America and Europe. I think we've got 72% in the US and 10% in Europe. So what's the opportunity in the Middle East and how are the different geographies panning out?
So in terms of geographies, what we saw last quarter, which was very heartening, was that all our, we were able to show growth in all of our geographies. And if you see the press release, we had deal wins across all the 4 geos, that is Middle East, ANZ, Europe, and in India and in USA. And specific to Middle East, we in the last couple of quarters, we've actually got 2 large customers where starting off with more on the infrastructure and security services space, where we've started ramping up these 2 accounts. And we expect that to continue. We also have a couple of large deals that are currently being discussed. So we are quite optimistic about Middle East. In terms of the geos that we expect, that for this quarter and the next quarter, the visibility that we have, that the growth will be across all 4 or 5 geos. And we are especially heartened to see Europe, which was an area of focus, where the percentage or market share of revenue had dropped in FY20. We're seeing that rebound back in the current year. So across the 5 geos that we operate in, which is ANZ, Middle East, India, Europe, and USA, we're seeing good traction and pipeline building up. So we're quite optimistic that we'll see growth across the board.
Right. Joseph, Venkat, both of you, thank you so much for taking the time out and joining in today.